Something extraordinary just happened in the gold market, and I need you to understand what this means for your wealth right now. For decades, gold and stocks moved in opposite directions. When stocks went up, gold went down. When markets crashed, gold soared. This inverse relationship was as reliable as gravity. It was the foundation of every diversification strategy, every risk management playbook, every wealth preservation plan written in the last half-century. That relationship just shattered. In 2024, gold and the S&P 500 achieved a correlation coefficient of 0.91. Let me put that in perspective. A correlation of 1.0 means two assets move in perfect lockstep. A correlation of negative 1.0 means they move in perfect opposition. For the past 50 years, gold and stocks typically showed negative correlation, or at best, weak positive correlation around 0.2 to 0.3. 0.91 is unprecedented. It's the highest correlation between gold and stocks ever recorded in modern market history. Both assets hit all-time highs simultaneously in 2024. Gold surged past $2,700 per ounce, while the S&P 500 delivered its best two-year performance since the dot-com era. They rallied together, day after day, week after week, month after month. The traditional playbook says this shouldn't happen, but it did. And here's what terrifies me. This isn't just a statistical anomaly. This correlation break is telling us something profound about the nature of the crisis we're entering. Because when safe havens start moving with risk assets, when the escape routes start following the same path as the danger zones, it means the entire financial system is responding to a threat bigger than any individual asset class. Let me show you what's really happening here. The traditional narrative about gold is simple. It's a safe haven. When investors get scared, they sell stocks and buy gold. When confidence returns, they sell gold and buy stocks. This push-pull dynamic kept the two assets moving in opposite directions for generations. But that narrative assumes normal market conditions. It assumes the financial system operates within historical parameters. It assumes central banks follow conventional monetary policy. It assumes the dollar maintains its reserve currency status without serious challenge. None of those assumptions hold true anymore. What we're witnessing is a fundamental regime change in global finance, and both gold and stocks are responding to the same underlying force. That force is monetary debasement on a scale never before attempted in human history. Think about what happened over the past 4 years. The Federal Reserve expanded its balance sheet by trillions. The U.S. government ran deficits exceeding $2 trillion annually. M2 money supply exploded by 40% in just 2 years during the pandemic response. Every major central bank on the planet engaged in unprecedented monetary expansion simultaneously. This wasn't traditional stimulus. This was monetary regime change, disguised as crisis response. And here's the critical insight. Both gold and stocks are responding rationally to this new reality. They're not moving together because markets are broken. They're moving together because they're both escaping the same thing: the devaluation of fiat currency. Stocks aren't rising because corporate earnings are exploding. They're rising because the dollar is being systematically devalued. When you measure the S&P 500 in gold terms rather than dollar terms, the picture looks completely different. The stock market's gains largely disappear. What looks like a bull market in dollar terms is actually just currency debasement in disguise. Gold is doing what it always does. It's maintaining purchasing power as fiat currency loses value. But now stocks are doing the same thing. Not because companies are fundamentally more valuable, but because the measuring stick itself is shrinking. This is why the correlation broke. Both assets are fleeing the same burning building: the dollar. Let me give you a specific example of how this plays out in the real world. In January 2020, before the pandemic, the S&P 500 stood at 3,225 points. Gold traded at $1,550 per ounce. Fast forward to December 2024. The S&P 500 hit 6,100. Gold reached $2,700. In dollar terms, stocks doubled and gold gained 74%. Impressive, right? But now measure it differently. In January 2020, you could buy 2.08 ounces of gold with 1 unit of the S&P 500. In December 2024, you could buy 2.26 ounces. The stock market gained just 8.6% in gold terms over those 4 years. All that apparent wealth creation was mostly monetary illusion. This is the secret the correlation break is revealing. We're not in a bull market. We're in a currency crisis disguised as a bull market. And the institutions know it. That's why their behavior has changed so dramatically. Central banks purchased over 1,000 tons of gold in 2022. They bought another 1,037 tons in 2023. In 2024, they're on pace to exceed those records again. This is the highest sustained level of central bank gold buying in history. These aren't retail investors panicking. These are the world's monetary authorities systematically accumulating physical gold at any price. Why? Because they see what's coming. They understand that the current monetary system is unsustainable. They're preparing for a reset, and they're making sure they have real assets when that reset occurs. Look at China. The People's Bank of China reported adding gold to its reserves for 18 consecutive months through mid-2024. But here's what's interesting. Many analysts believe China's actual gold holdings far exceed what they officially report. The country is the world's largest gold producer, mining over 370 tons annually. Almost none of that gold leaves China. It all stays within the country's borders. China is accumulating gold while simultaneously reducing its holdings of U.S. Treasury securities. In 2023 alone, China reduced its Treasury holdings by over $100 billion. This isn't random portfolio rebalancing. This is strategic repositioning ahead of a monetary regime change. Russia took even more dramatic action. After Western sanctions froze hundreds of billions in Russian foreign exchange reserves in 2022, Russia accelerated its gold accumulation. The Central Bank of Russia now holds over 2,300 tons of gold, representing roughly 25% of its total reserves. They learned the hard lesson that dollar-denominated assets can be weaponized. Gold cannot. The BRICS nations collectively now hold over 5,000 tons of gold. They're actively discussing the creation of a gold-backed trade settlement currency. Whether that specific initiative succeeds or fails is almost irrelevant. What matters is the signal it sends. The world's largest emerging economies are openly preparing for a post-dollar monetary system, and they're using gold as the foundation. This is why gold and stocks are moving together. The smart money understands that in a world of unlimited fiat currency creation, all scarce assets rise together. Stocks represent ownership in productive enterprises. Gold represents monetary value that cannot be printed. Both are superior to holding depreciating paper currency. But here's where it gets really interesting. This correlation won't last forever. At some point it will break again, and when it does, the divergence will be violent. Let me explain why. Right now, we're in the everything bubble phase. Monetary expansion lifts all boats. Stocks rise. Gold rises. Real estate rises. Even cryptocurrencies rise. Everyone feels wealthy. The system appears stable. But this phase is inherently unstable. It requires continuous monetary expansion to sustain. The moment that expansion slows or reverses, the correlation will shatter. And when it does, gold and stocks will violently diverge. History provides a perfect example. In the 1970s, we saw a similar pattern. From 1971 to 1980, both gold and stocks rose together in nominal terms. The Dow Jones went from 900 to 1,000. Gold went from $35 to $850. They moved in the same direction, both responding to monetary debasement and inflation. But then came the divergence. From 1980 to 2000, stocks soared while gold collapsed. The Dow went from 1,000 to 11,000. Gold fell from $850 to $250. The correlation completely reversed. What changed? Paul Volcker changed. He raised interest rates to 20%, crushed inflation, and restored confidence in the dollar. That policy shift ended the monetary debasement phase and began a 20-year period of dollar strength. Stocks thrived in that environment. Gold suffered. We're approaching a similar inflection point now. But this time, the divergence will likely favor gold, not stocks. Here's why. In 1980, the U.S. was the world's largest creditor nation. Today, we're the world's largest debtor. In 1980, U.S. debt to GDP was 35%. Today, it exceeds 120%. In 1980, the U.S. ran trade surpluses. Today, we run massive trade deficits. In 1980, the dollar faced competition from gold. Today, it faces competition from gold, cryptocurrencies, and alternative reserve currencies. The Volcker solution worked in 1980 because America had the economic strength to endure the pain of 20% interest rates. We don't have that strength today. Our debt burden is too large. Our deficits are too structural. Our economy is too financialized. If the Fed tried to raise rates to 20% today, the U.S. government's interest expense would exceed $5 trillion annually. That's more than total federal revenue. The government would default. The financial system would collapse. It's not an option. So the Fed is trapped. They can't raise rates high enough to restore dollar confidence without destroying the economy, and they can't keep rates low without accelerating currency debasement. They're caught between two impossible choices. This is why the correlation will eventually break, and when it does, gold will soar while stocks struggle. Because the only path forward is more monetary expansion, more currency debasement, more inflation. And in that environment, gold wins while stocks lose purchasing power. The technical setup supports this thesis. Gold just broke out of a 13-year consolidation pattern. From 2011 to 2024, gold traded in a range between $1,050 and $2,075. It tested the upper boundary multiple times and failed, until 2024. In March 2024, gold finally broke through $2,075 and never looked back. It surged to $2,200, then $2,400, then $2,600, then $2,700. Each breakout held. Each consolidation led to another leg higher. This is textbook bull market behavior. The breakout from a 13-year base is enormously significant. In technical analysis, the longer the base, the bigger the subsequent move. A 13-year base suggests a multi-year bull market ahead, with potential gains of 100% to 200% or more. If gold follows the pattern of its previous bull market from 2001 to 2011, we could see prices reach $5,000 to $7,000 per ounce over the next 5 to 7 years. That's not speculation. That's pattern recognition based on historical precedent. But here's what concerns me most. The correlation break suggests this bull market might be even larger than the 2001-2011 rally, because the underlying monetary crisis is more severe. The debt levels are higher. The currency debasement is more extreme. The geopolitical tensions are more acute. Every factor that drove gold from $250 to $1,900 between 2001 and 2011 is present today in amplified form. Plus new factors that didn't exist back then. De-dollarization, BRICS currency initiatives, central bank digital currencies, the weaponization of the dollar through sanctions. The 2001-2011 bull market was driven by one primary factor: loss of confidence in fiat currency following the dot-com crash and the 2008 financial crisis. The current setup involves loss of confidence in fiat currency, plus loss of confidence in the dollar's reserve status, plus loss of confidence in the entire post-World War II monetary order. This is bigger, much bigger, and the smart money is positioning accordingly. Look at the flows into gold ETFs. After years of outflows, institutional money is flooding back into gold. The largest gold ETF, GLD, saw inflows exceed $10 billion in 2024. That's the strongest annual inflow since 2020. But here's what's really interesting. Those ETF inflows represent just a fraction of total gold demand. The real action is happening in physical gold markets. Premiums for physical gold coins and bars remain elevated. Delivery delays persist. Refineries are running at full capacity. The premium of physical gold over paper gold continues to widen. This tells us something critical. The gold market is bifurcating. Paper gold, the futures contracts and ETFs, trades at one price. Physical gold, the actual metal you can hold in your hand, trades at a premium. That premium reflects growing distrust in paper claims on gold. Investors are learning the lesson that Russia learned. Paper claims can be frozen, confiscated, or devalued. Physical gold cannot. When the crisis intensifies, that premium will explode. We could see physical gold trading 10%, 20%, even 30% above paper gold prices. This is why central banks buy physical gold, not ETFs. They want the actual metal, stored in their own vaults, under their own control. They understand that in a true crisis, paper claims are worthless. And this brings me to something important. If you're sitting on $100,000 or more in retirement accounts, you need to understand how gold IRAs work. I put together a free guide that covers exactly how to get physical gold into your retirement account without tax penalties. It's in the description below. Worth checking out if that's relevant to your situation. Because here's the thing. Most retirement accounts are 100% exposed to paper assets. Stocks, bonds, mutual funds, all denominated in dollars, all vulnerable to currency debasement. A gold IRA lets you hold actual physical gold within a tax-advantaged retirement structure. It's one of the few ways to protect retirement wealth from monetary debasement while maintaining tax benefits. Anyway, back to where this price is headed next. The supply-demand fundamentals for gold have never been more bullish. Mine production peaked in 2018 and has been declining since. It takes 10 to 15 years to bring a new gold mine into production. The easy gold has been found. New discoveries are rare. Production costs are rising. Meanwhile, demand is accelerating. Central banks are buying at record levels. Asian consumers, particularly in China and India, are accumulating at unprecedented rates. Western investors are returning to gold after years of neglect. Industrial demand for gold in electronics and technology continues to grow. The math is simple. Supply is constrained and declining. Demand is growing and accelerating. Price must rise to balance the market. But there's another factor that could send gold prices parabolic: the gold derivatives market. The paper gold market is enormous. Hundreds of billions of dollars in gold futures, options, and swaps trade daily. The notional value of gold derivatives dwarfs the value of physical gold available for delivery. This creates massive leverage in the system. Most of these paper contracts are settled in cash, not physical gold. But the contracts give holders the right to demand physical delivery. If even a small percentage of contract holders demand physical gold instead of cash settlement, the system could break. This is what nearly happened in March 2020. As the pandemic hit, gold futures prices in New York diverged from physical gold prices in London by over $70 per ounce. The basis, the difference between futures and physical, exploded to levels never seen before. The COMEX, the exchange where gold futures trade, came within days of defaulting on delivery obligations. The Fed had to intervene, arranging emergency airlifts of physical gold from London to New York to prevent a complete breakdown of the gold derivatives market. Most people never heard about this, but it was one of the most significant events in gold market history. That crisis was resolved, but the underlying problem remains. The paper gold market is far larger than the physical gold available to back it. It's a fractional reserve system, just like banking. And like banking, it's vulnerable to a run. If confidence in paper gold breaks, if investors start demanding physical delivery en masse, the price of physical gold could gap up by hundreds or even thousands of dollars overnight. The paper market would collapse. Only physical gold would have value. This is the ultimate expression of the correlation break. Right now, gold and stocks move together because both are escaping currency debasement. But when the paper gold market breaks, when the derivative system fails, gold will decouple violently from everything else. That's the moment when gold fulfills its true purpose, not as an investment, not as a speculation, but as the ultimate form of money. The only asset that carries no counterparty risk, the only store of value that has survived every monetary crisis in human history. And that moment is coming. The signs are everywhere. Look at what's happening in the Treasury market. The U.S. government is issuing debt at unprecedented levels. Over $2 trillion in new Treasury securities every year. But foreign buyers are stepping back. China is selling. Japan is selling. Saudi Arabia is diversifying away from dollars. Who's buying all this debt? The Federal Reserve. Through various mechanisms, direct and indirect, the Fed is monetizing government debt. They're printing money to buy bonds. This is the definition of monetary debasement. And it's accelerating. The Congressional Budget Office projects deficits exceeding $2 trillion annually for the next decade. There's no political will to cut spending. There's no economic capacity to raise taxes enough to close the gap. The only solution is more money printing. This is why gold is breaking out. This is why central banks are accumulating. This is why the correlation with stocks is at record highs. Everyone who understands monetary economics sees what's coming. The dollar is losing its reserve currency status. Not overnight. Not in a dramatic crash. but gradually, inexorably, as countries around the world reduce their dollar exposure and increase their gold holdings. The process is already well underway. The dollar's share of global foreign exchange reserves has fallen from 72% in 2000 to under 59% today. That's a massive shift, and it's accelerating. Every time the U.S. weaponizes the dollar through sanctions, more countries decide to reduce their dollar dependence. Every time the Fed prints trillions to bail out the financial system, more investors lose confidence in dollar stability. Every time the government runs trillion-dollar deficits, more creditors question America's ability to repay its debts. These trends are irreversible. The dollar will remain important for years, perhaps decades, but its dominance is ending. And as that dominance fades, gold's role in the global monetary system will expand. This is the megatrend driving gold prices. Not inflation, not interest rates, not geopolitical tensions. Those are all factors, but they're symptoms of the deeper trend. The end of the dollar's unchallenged supremacy as the world's reserve currency. And here's what makes this moment so critical. We're at the inflection point, the transition from dollar dominance to a multipolar monetary system. This transition will take years to fully play out, but the early stages are happening right now. The correlation break between gold and stocks is the market's way of signaling this transition. Both assets are rising together because both are escaping the dollar. But eventually, they'll diverge. Stocks will struggle as the economy adjusts to a weaker dollar and higher inflation. Gold will soar as it reclaims its role as the ultimate monetary asset. The question isn't whether this will happen. The question is when, and how violent the transition will be. I believe we're in the early stages of a gold bull market that will last 5 to 10 years and take prices to levels most people consider impossible today. $5,000 gold, $7,000 gold, perhaps even $10,000 gold. These aren't wild predictions. They're mathematical outcomes based on the amount of currency debasement already baked into the system. If you adjust gold's 1980 peak of $850 for real inflation, not the government's manipulated CPI, gold should already be trading above $15,000 per ounce just to match its previous high. We're not in a bubble. We're in the early stages of a revaluation. Gold is catching up to decades of currency debasement, and it has a long way to go. The correlation break is your warning signal. It's telling you that the rules have changed. The old playbook doesn't work anymore. Diversification between stocks and gold isn't enough when both are responding to the same underlying crisis. You need to think differently. You need to understand that we're not in a normal market cycle. We're in a monetary regime change. And in regime changes, the assets that preserve wealth are different from the assets that generate returns in normal times. Gold isn't an investment. It's insurance. It's the asset you hold when everything else is uncertain, when currencies are being debased, when governments are running unsustainable deficits, when central banks are trapped between impossible choices. This is that moment. The correlation break is telling you that the system is under stress. Both gold and stocks are rising together because both are fleeing the same problem. But that correlation will break again. And when it does, you want to be holding the asset that has survived every monetary crisis in human history. The secret correlation just broke, and it's revealing a truth that most investors don't want to face. We're not in a bull market. We're in a currency crisis. And the only way to protect your wealth is to own assets that can't be printed, debased, or devalued by government decree. Gold is that asset. It always has been. And the market is finally waking up to that reality. The question is, will you wake up in time?